Most sponsors learn the hard way that capital does not fall into place just because a project looks good on paper. They race from deal to deal, pulling together a quick package, calling a few lenders, and hoping something sticks. The capital roadmap most sponsors never build is the quiet reason those deals stall, drag out, or die in front of a credit committee. Institutional lenders and investors are not buying a slick pitch deck or a single building. They are buying future cash flows at a risk-adjusted return, and they want clear proof that the sponsor understands how to create, protect, and grow those flows without breaking the business or the asset. A real capital roadmap turns that expectation into a concrete plan that can stand up to questions from banks, pension funds, private credit funds, and family offices across Canada. For Canadian developers and operating companies working on projects from $1 million to $500 million, that plan is now the baseline, not a nice extra. Without it, capital readiness strategy becomes guesswork. Deals bounce between lenders, and sponsors accept weaker terms simply because they run out of time. The capital roadmap most sponsors never build is costing them approvals, equity, and long-term relationships they could have earned. Key takeaways. A capital roadmap is not a pitch deck. It is a long-term framework that guides how, when, and from whom you raise money. With that map, your capital stack and timing follow a plan instead of guesswork. Most sponsors lose deals not because the project is weak, but because their story falls apart under lender questions. A clear roadmap answers the questions credit teams actually ask. That keeps investors at the table instead of walking away. Institutional lenders and investors weigh the sponsor as heavily as the asset. They look at track record, transparency, and how well you explain risk mitigation in real estate development. Strong preparation here often matters more than the property itself. A three-layer structure with thesis, evidence, and execution turns scattered data into a simple capital story. It shows the real estate capital stack structure, the risk-adjusted return profile, and how the plan will deliver them. That makes your commercial real estate financing roadmap feel solid, not speculative. Working with an experienced structured transaction advisory partner saves years of trial and error. A firm such as Equis Capital Finance brings market insight, lender relationships, and real execution experience. With that support, sponsors move from reactive fundraising to a stable sponsor capitalization strategy that matches institutional expectations. What is a capital roadmap, and why most sponsors don't have one? For many sponsors, capital raising is a sprint that starts when a property goes under contract or a construction tender comes back. The focus shifts to assembling a pro forma, sending a quick package to a few lenders, and pushing hard for a yes. That approach may work once in a while, but it does not create a repeatable capital readiness strategy. A capital roadmap is different. It is a forward-looking framework that maps the full capital path for a business or project. That path usually covers real estate capital, stack structure, development, financing strategy, capital sequencing strategy, lender targeting, exit strategy in real estate, financing. Instead of reacting to each deal, you build a standing plan for how your projects will be funded from day one through takeout. Done well, a roadmap shows institutional partners how the sponsor creates and protects value, why the project's advantages can last, and how financial performance supports long-term growth. It makes the risk-adjusted return profile clear, including leverage levels, coverage ratios, and expected liquidity durability across different market conditions. In other words, it translates a narrative into numbers that can be underwritten. Without that structure, the costs pile up. Projects stall at term sheet stage. Credit committees ask for more information that the sponsor has not prepared, and equity gets diluted simply to keep things moving. Raising money without a roadmap is like applying for a mortgage with no credit history or pay stub. The opportunity may be real, but the lender has no framework to say yes, especially in a Canadian market where banks, insurers, pension funds, and private lenders now expect institutional-grade documentation as standard. The trust gap. Why sponsors fail before the first meeting. Many sponsors do not miss out on capital because the asset is weak. They miss out because they are answering questions investors are not asking and skipping the ones they care about most. That gap between what a sponsor talks about and what an underwriter needs to see is where confidence disappears long before a full meeting or a site visit. Several patterns show up again and again. Using marketing language instead of capital markets language is a common problem. Phrases about massive upside or a game-changing project may sound exciting, but they signal that the sponsor is not thinking in underwritable terms. Institutional underwriting criteria are built around facts such as loan-to-cost ratios, debt service coverage, pre-leasing, and exit cap rate support. When a sponsor leads with slogans instead of these numbers, credit teams assume the hard work is missing. Showing growth without unit economics leaves lenders cold. A development may promise rapid lease-up, strong rent growth, or aggressive expansion, yet never explain how much capital is consumed to get there. Underwriters want to see capital efficiency and a clear link between each dollar invested and each dollar returned. They care how the plan holds up if lease-up slows, operating costs rise, or interest rates move during construction financing planning. Picking the wrong comparables can damage trust fast. Benchmarking a $5 million mixed-use project in a secondary market against a flagship tower in downtown Toronto tells a lender that the sponsor has not done the homework. Sound comparisons match asset class, size, age, and location, and support pricing, cap rates, and leverage that fit the actual risk profile. Quoting KPIs without linking them to money creates noise instead of confidence. Occupancy, pre-sales, absorption, and construction milestones all mean little unless they tie back to cash flow, coverage, and exit value. Metrics in a capital roadmap need a clear line of sight to interest payments, principal repayment, and equity returns. Seasoned lenders also study the sponsor just as carefully as the deal. They look at how you speak about past setbacks, how clearly you describe your development risk removal strategy, and how open you are with data. As many credit officers like to say, experienced capital providers do not just lend against an asset, they lend against the operator sitting across the table. The three-layer framework. Every capital roadmap needs. A powerful capital roadmap is not a long document full of charts. It is a clear structure that helps an investor move from high-level thesis to detailed execution without getting lost. One practical way to do that is to build around three layers that every institutional partner expects to see. Layer 1. The investment thesis. The why. The investment thesis is a single, tight statement that connects the market opportunity, your advantage, and the expected financial outcome. It should be specific enough that an underwriter can start a file from that one line. Vague promises about growth or disruption do not survive first contact with a credit committee. A strong thesis might read like this in a Canadian context. We are acquiring and repositioning secondary market industrial assets in Ontario at a 20% discount to replacement cost, targeting a 6.5% stabilized cap rate and a 1.35 times debt service coverage ratio within 18 months. In one sentence, a lender can see the asset type, pricing edge, target income yield, and debt profile. That kind of thesis frames the whole real estate project capital strategy. It gives you a reference point for capital stack hierarchy, from senior debt through any mezzanine layer to common equity. It also makes your development financing strategy much easier to explain, since every step should support that first statement. Layer 2, the evidence. The proof. Once the thesis is clear, you need proof that it is realistic. That proof comes from a small set of value drivers, each backed by data and a direct link to financial results. This is where structured real estate finance meets track record. Example: structure, asset repositioning, buying. Underperforming assets below replacement cost, purchase price 20% below recent sales, forced equity creation of about $1.2 million at stabilization, phased construction financing, draw schedule tied to pre-leasing and milestone tests, 75% pre-leasing before first major draw, lower lender risk and support for limited recourse structure, contingency reserve planning, 10% hard cost reserve built into the capital stack, construction cost variance kept under 5% on last 3 projects, stronger confidence at credit committee and faster approvals. Without data, you're just another person with an opinion. W. Edwards. Deming. Well-structured evidence is what turns your story from a sales pitch into something a credit team can test and rely on. Layer 3. The execution roadmap. The how. The final layer is the execution roadmap, which focuses on value inflection points rather than a simple Gantt chart. It shows how capital sequencing strategy, construction steps, leasing, and exit timing all line up. Weak language: secure financing, start construction, lease up. Strong language: Quarter 1. Close senior construction facility at 75% loan to cost. Quarter 3. Reach 60% pre-leasing to trigger a small mezzanine tranche. Quarter 4 of the following year, refinance into long-term debt at stabilized value and return most equity within 24 months. A good execution roadmap also maps phased capital raising strategy, including bridge loan sequencing, mezzanine layers, and private credit. It spells out the exit strategy in real estate financing and shows that the project can handle stress while maintaining liquidity, durability, and a reasonable risk-adjusted return profile. How Equus Capital Finance helps sponsors build institutional-grade roadmaps. Building a capital roadmap of this caliber takes more than drive and a strong asset. It calls for deep knowledge of Canadian capital markets, structured finance skill, and access to the right lenders and investors. With more than 2 decades of experience originating, negotiating, structuring, and closing commercial loans above $1 million, Equus Capital Finance guides clients through the full capital planning process. Business planning and financial advisory support includes preparing investor-grade business plans, financial projections, credit memorandums, and investor presentations aligned with institutional underwriting standards. Structured finance and construction finance support helps sponsors design custom capital structures, including senior debt, mezzanine layers, and equity structures suited to the project. Through its extensive lender network across banks, insurance companies, pension funds, credit unions, trust companies, and private capital providers. Equus Capital Finance matches sponsors with appropriate capital sources. Because the firm's independently owned, its guidance remains focused on the client's interests, from early capital readiness through structured transaction advisory and closing. Conclusion. The capital roadmap most sponsors never build is not a nice-to-have document. It is the foundation that determines whether institutional lenders and investors can approve a deal on terms that support long-term success. A strong roadmap follows a simple pattern: a clear investment thesis, evidence that supports the thesis, an execution roadmap that explains how capital moves through the project. Sponsors who treat capital planning as a standing business discipline consistently perform better in Canadian commercial real estate and corporate finance markets. For many sponsors, the fastest path to that level of preparation is working with an experienced advisor, such as Equus Capital Finance, to convert informal planning into a repeatable capital strategy. If you are preparing to approach banks, private credit, or institutional investors, the fastest way to improve outcomes is to stop patching the package and build a defensible capital roadmap first. Project Navigator TM is Equus Capital Finance's structured capital readiness review that pressure tests your financing story the way a credit committee will before you go to market. You receive a clear roadmap of what is missing, what matters most, and what must be rebuilt to reach an institutional-ready standard. FAQs. What is a capital roadmap in real estate development? A capital roadmap is a forward-looking plan that maps the entire funding path for a project, including senior debt, mezzanine financing, and equity layers. It also outlines timelines for acquisition, construction, lease-up, refinancing, and exit. What do institutional lenders look for in development financing? They evaluate loan-to-cost ratios, debt service coverage, sponsor experience, contingency reserves, market demand indicators, and the credibility of exit assumptions. How do you structure a capital stack for a development project? Typically, the structure begins with senior construction debt, followed by mezzanine or subordinated debt, preferred equity, and common equity. Why do sponsors fail to raise institutional capital? Most failures occur because documentation and financial models do not meet institutional underwriting standards or lack clear capital sequencing and exit strategies. How can a structured finance advisory firm help? A structured finance advisory firm helps sponsors prepare institutional-grade financial models, lender memorandums, capital structures, and introductions to appropriate funding sources.